stop watching Shark Tank because that's not the way you're going to go. We have to get 10x return on our money in a certain period of time.
Let's look at numbers. How much did you sell the first time?
3 million, 4 million.
You started another company that did the same exact thing?
And then we sold it again.
How much was that?
It was more.
John Maroney is a partner at the Oregon Venture Fund. For the past decade, he's been on the hunt for new startups, building investor relationships, and putting deals together.
I wanted to invest locally to support local companies. I just wanted to make Oregon a better place.
How do you make investing decisions? It's a very daunting thing to know fact from fiction, what's real, what's not.
The entire way of creating companies has changed. They're raising much less money to go much further, and they're already very far along.
Today, he's going to share the metrics he looks for before investing in a company. And we'll discuss the current economic state of Portland. Spoiler, it's not what you think.
Companies are moving out of Oregon.
But people want to live on the West Coast. They're coming from LA, San Francisco, and New York. The real estate here is the cheapest real estate on the West Coast.
The situation in Portland is pretty dire.
There's no reason to have an office downtown anymore.
John, let's zoom out, and I want to ask you something that's quite controversial. What's up, guys? Quick break over here. 80% of you guys listening are not subscribers. The more subscribers we get, the bigger and better we can make the show.
And if you've been getting value from Matchbox, please hit that subscribe button below. For you, it's just a click. For us, it means a lot.
Thanks for watching, guys. John, thank you so much for coming on the show.
Yeah, thanks for having me.
Appreciate it. So for those that don't know, you are an integral part of the Oregon Venture Fund. Tell us a little bit about that, and then tell us your story of how your career started and how you got to where you're at.
Yeah, so Oregon Venture Fund is one of the leading funds for investing in Oregon and Southern Washington. We invest about $15 million a year in startups, everything from $500,000 to $4 million into promising startups that are on the venture track of scaling and making the next great world-class companies right here. I got first introduced when I pitched my startup and got rejected. and then
You're not alone.
I'm not alone. Yeah, not alone. And ended up selling that company and started an accelerator working with early stage companies. And what I realized was that I had raised money for my startup, but I wasn't great at it. I didn't understand how investors thought. And so I said, oh, maybe I'll join the Oregon Venture Fund as an investor and I'll learn about the process through that. And so I joined as an investor, got really involved. And as the fund was still pretty small then. We were only investing maybe $2 million a year. And it was 40 people, 50 people, 50 investors. And we started growing. And as we started growing, they needed more people. And I was looking to create my own fund to support. I was running this accelerator. I was going to create my own fund to invest in my companies. And Eric Rosenfeld, the founder of OVF, was the only person I knew who had started a fund. And so I said, hey, could we go to lunch? Can you tell me how to do this? And so we went to lunch and he told me all the ins and outs and pros and cons. And at the end, he's like, why do you want to start a fund? And I'm like, I like working with entrepreneurs. And he's like, well, maybe you come join us and we do that together. And I said, I didn't know that was an option. Let's talk about that. And so that's how I got involved, going from investor to the general partner, where I've been for 10 years.
So you started off as an entrepreneur, got rejected, then you eventually got into the investor side and then basically partner with the fund. Those are the three steps.
I became an investor in the fund of what is now 200 people who invest money every year in the fund. And then I got involved in doing the diligence on startups and realized I liked doing that. And when the opportunity came, I said, oh, did you want to be a general partner and help us organize the work of the fund? Because that's really the goal of the management team at the Oregon Venture Fund, is to organize the work and is to convene and unleash the talent and the capital in the region. And that is these 200 people. And so that was the primary goal of what I was doing, is to say, hey, how do we find companies and then match it to the right talent in our network to help the companies, and to evaluate them, make sure that we're finding the right investment opportunities, and if not, to help them if we can.
I'm curious, what company was that you got rejected for?
So my company, I was entrepreneur. started a company called Free Range Communications. We were doing mobile software back before the iPhone came out. So we started with Blackberries. I don't know if you remember the old Blackberry.
Oh, yeah.
Of course.
Great for email, but terrible for internet. It just wasn't good at internet. And so we started a platform for getting content into apps. We created some of the first apps on BlackBerry. We didn't call them apps at the time. That terminology wasn't around.
What did you call them?
We were working on that still. It was programs or, on phone websites. We didn't have a good term yet. And, but we did that. And then when the iPhone came out, we started a platform so that we could work with big media companies, and they all wanted apps, and it was very expensive to do at the time. It was $250,000 to build one app on one phone. And we would say, great, we have iPhone, Android, BlackBerry. We'll connect to your content management system.
So you already had Android as well?
We did, yeah. And so we did all three, and then we would connect to your content management system that ran your website. So think about a newspaper, our first
CMS. Yeah.
We connect to the CMS, we connect to the ad system if they had one, and then we'd take your branding and we would create the apps for all the different platforms, and we ran it as a service. We would get it into the App Store and handle all those types of things. And then we would take a rev share of the advertising.
Okay.
And so we did it for, so dynamic content. So newspapers, media companies, websites, magazines,
I get an idea.
Sports teams. And so our first big customers were Wall Street Journal. Their first mobile apps were all run by us. Associated Press, Reuters, London Evening Standard, New York Daily News, the New York Knicks, the New York Rangers all had apps. We did the apps for
So you basically, if you go on a desktop, you have this full-blown website, and it's heavy, and you would parse some of the information and create a mini version of the website with the contents, with some pieces.
Yeah, we were using RSS feeds.
Okay.
So that we're already coming out of the content management system. We would take that, and that way
I remember.
So if the Wall Street Journal, you're reading the Wall Street Journal, you would get all the headlines coming to your phone on a regular basis, and all of those stories. And so you could dig down through the stories and navigate the stories.
So you raised money for that
We
company?
did, yeah. We raised like $2.5 million at the end of the day.
Oh, wow.
So all from individuals though. We didn't.
And what year was that?
2006, 2007.
So right when iPhone came out.
Yeah, in
But
2000.
when first iPhone came out, there was no app store.
Yes, there was no app store. And so when the app store finally came out 2 years later, the first day there was 500 apps in it, right? And of the top 100, we had like 35.
Wow.
Because they were all the brands that everyone already knew, and we provided those. And so that was Associated Press and Wall Street Journal. And
So when the App Store came out, your apps were actually in the App Store?
we were already powering all these brands because we started doing them for BlackBerry, and then we added iPhone and Android.
I see.
And so the first day, there's 500 apps in the store. Of the top 100, we had 35. On day 2, there was 1,000 apps in the store. We were down to about 20. And by the end of the week, we had like 7. But it was all, our strategy was, instead of creating our own brand, is we piggybacked on all these other brands. So we ended up with a lot of users really fast, because the Wall Street Journal came around. We got 50,000 users in 2 days, right? And they put big ads in the Wall Street Journal. Get the Wall Street Journal on your phone. And so we got a lot of users really fast. So
when you say you had big ads, like where were you running these advertisements to get the users?
we weren't. The Wall Street Journal was.
They were
in their own newspapers, and it was like, it was a full. I just found it the other day. That's why it's top of mind. You can imagine I made giant posters of it, but it was a full page ad. And it was like, get the Wall Street Journal on your phone, and it was a new thing for anyone. And so click here to get the app, or not click here, but like, here's a URL to get the app on your phone.
No QR codes at that time.
No.
Yeah,
and
the cameras weren't good enough.
Yeah. And so, so that's how we piggybacked. Our strategy was, let the Wall Street Journal already has a distribution. They already have the audience. We're going to provide the technology to let them reach that audience in a new way. And we get to share revenue.
Was there ever concern that you would build out this system, you'd have all these customers, but eventually they would just want to vertically integrate and cut you out? and do everything themselves? Like, what was your?
Yeah, I mean,
Yeah.
ultimately, that's what
That's what happened.
yeah,
HTML5
the
and-
technology it evolved. It was more technology than a strategy. I think is that the
Mhm.
technology evolved so that it got easier. So that where it cost $250,000 to build the first version, it actually got worse after that because then everybody was like, "Well, we need to have this in house because this is key technology." They would hire 10 people, and to
Yeah.
wow.
and we had multiple customers where we would run for a year and they'd be like, "No, we need to take it in house." And then they'd hire 10 people. And then 6 months later, they'd come back and be like, "Hey, yeah, so that didn't work out so well. Can we go back to you guys?" Yeah, it was great. It was a good, so ultimately we were going to get displaced. Like now it's, you can vibe code an app, right?
Right. Exactly.
And so, but this was, whatever, 15 years ago.
Mm-hmm.
And at that time, the development tools were getting better so that it was becoming a lot cheaper for you to do apps on your own. And so recognizing that, we sold the business.
Can we talk about that?
Yeah.
So you raised 2.5 million.
Roughly, yeah. It was
then-
two tranches of
And then
all individuals.
Did you realize you need to get out fast? Or you still thought that the business is viable, we can keep growing?
When we sold the business, the iPhone, the App Store wasn't even open yet, I don't think.
Oh, okay.
It was just opening up. And it was 2008. It was the end of 2008. And all the capital dried up. And we had Wall Street Journal, Associated Press, Reuters, London. I had this great list of customers, and I didn't have enough capital to deliver the products and service them as we went along.
Mhm.
And all the capital, like 2008 was the crash, and everyone's stopped investing. And so going back to the story of the Oregon Venture Fund, like I went to OVF and I went through the process, and they're like, "Okay, well, we have this meeting coming up on December 7th, and we will decide whether or not we're going to invest in you on that day." And I said, "That's great. I'll come. I'll give you a great deal. I'm going to give you a very good valuation, but you need to tell me that night, because if you don't, I actually have a term sheet to sell the company that I have to sign the next day."
Okay.
And a competitor had come to us who we kept beating they were trying to get the business with Wall Street Journal and Reuters and Associated Press, and we kept beating them for the business. And they were finally like, "Okay, we're just going to buy them." And so at that point, we didn't have much. I didn't feel like we had a lot of choice, and so we sold the company then, and then we worked at the company that acquired us for 2 years, which is kind of the earn out of your stock for part of it.
Yeah.
And then we spun the company back out again, and then we sold it again 2 years later.
Okay, hold on. So you sold the company.
Yeah.
Part of the agreement, you have to stick around for 2 years.
Yeah.
In 2010, you started another company that did the same exact thing?
So closed in 2009, 2010, 2011. At that point, the company that acquired us, they had spread out it had gotten too big. Like they had too many business units. And so we basically spent 2 years growing the free range business and rationalizing the other businesses. So we were laying people off, focusing on 3 business units. And at the end of it, we spun off they didn't want to do our business anymore. They thought they had a better business doing advertising platforms, and which they ultimately sold to Sprint. So it was a good decision. It was probably a good decision all around. Yeah.
Okay.
So we spun it back out again.
So your business unit spun up into another
basically
company.
But
gave it back to us.
Within, what's the name of that company?
That was called Free Range again.
Free Range?
Yeah, we took it back as Free Range.
How do you take it back? You just bought it back at pennies on the dollar?
They needed the technology to run some of their other things.
Okay.
And they needed the people that were part of my team here in Portland. They were in Kansas City. And so they said, "We'll give you the company back in return for you supporting us for the next year."
I see.
Interesting.
Technology side. Yeah.
That sounds like a good deal. So when
Yeah,
you sold
I thought it was a very fair deal, actually. I was like,
okay.
I thought that it was a good deal for us because the business was much bigger at this point and was self-sustaining and
not burning
cash. We were now further along. The signs of technology change were coming though. And so, but like these companies where we started and we said, "Oh, it's a very small fee and we'll take a revenue share of advertising." And they were like, "Oh yeah, there is no mobile advertising." Well, 2 years later, this is starting to be,
Big one.
it's starting to be more substantial every month,
Right.
to the point where they're like, hey, so we're paying you a lot every month. Let's talk about that. I'd say, yeah, okay. At this point, I'm happy to talk to you.
Okay.
You wouldn't have paid me before, but now you'll pay me.
Let's look at numbers.
Yeah.
So how much did you sell the first time?
The first time we sold it was 3 million, 4 million.
3-4 million.
Yeah.
So almost break even because you invested. There's resources. There's outside investors. 2.5 million, right?
Yeah, they got stock in the new company that bought us. So it was a stock deal. So
It was all stock deal.
it was mostly stock deal.
Okay.
Yeah. And so the investors got stock in the new company. When that old company exited, they got their returns.
Got it.
Yeah.
So you had stock. That's why you had interest in free range, right? To keep pushing it.
Yeah.
And when I told you, you can, again,
I had stock in the whole company
right.
and the acquiring company. And then when we spun it out again, we gave them back the stock in the whole company, and they gave us all the stock in
I see.
the new company. So
Did
that's
you get that?
technically how it works. Yeah.
Okay. And you sold it again,
And then we sold it again.
but now for cash.
Yes, to a public company. So.
Okay.
It
Okay.
Yeah.
How much was that?
was more.
It's so shy. More than 3, like 10 million.
Yeah, it was in that range. So
Yeah.
yeah. It was still a fairly nascent small company, but it was we were happy with the outcome. So
And now you have this cash and you want to start investing.
Yeah.
Which is pretty common for people that exit.
Yes.
They're like, okay, I have all this cash.
Yeah.
And instead of going to a fund that will guarantee you what, 7% at the time, now it's more, but
I did it a little more philosophically. You can send your money to New York, right, and invest in the stock market
with potentially 7%.
with potentially whatever, knowing that it's getting scraped along the way. Everyone's taking their little bit along the way.
Yeah.
And I guess I feel like I'm not
It's just
good at it.
it's not exciting.
And it's not exciting. I wanted to invest locally to support local companies. I like going around when my kids were younger and being like, hey, you know that we're invested in Salt and Straw. You know, we're invested in this. And I just wanted to make Oregon a better place. So that's this region is why I live here. And
Were you born here?
No, I'm from outside Philadelphia.
Mm.
And at what point did you come to the Portland metro area?
25 years ago, 2000.
25 years,
Yeah.
2000. Wow.
I came in 2004.
Oh, nice.
Yeah.
You were here before Vlad.
Oh.
So when you got here, boots on the ground, it was the .com era. When you had your first startup, it was the mobile era.
Yeah.
Fast forward, you had social, and then fast forward even more. Now we have AI. You mentioned vibe coding. How has the investing scene changed, right? Like if you're in the venture capital industry,
Yeah.
I feel like it's a very daunting thing to know, like fact from fiction, like what's real, what's not with AI. How do you make investing decisions in these new times?
I mean, it's step back. The entire way of creating companies has changed. So when I started this free range company, I remember going and getting, like, we got money from people we knew, but the very first check I got from someone who I had never met before, like I'd met them, but they were introduced to me, but it wasn't someone I already knew. $25,000. I was so excited. I came back and I showed it to my business partners who were this front end engineer and the back end engineer. And the back end engineer, he goes, "Oh, can I see that check?" I'm like, "Yeah, it's real. Look." And he pulls it out. He's like, "Good. I hope it's real because I need that." And he like folds it up and put it in his pocket. I'm like, What are you doing?" He's like, "We're going to buy a server with that." I'm like, "For the whole thing?" He's like, "Yeah. Do you want your service to work?" I'm like, "Yeah." He's like, "Well, then you need a server."
$25,000.
So it was and I'm like, "It's going to take the whole bit?" And he's like, "Yeah." And then it takes another 25,000 to run it for a year.
So there was no AWS.
This was before AWS. So
Wow.
AWS was just about to come out. And so I had a front engineer, a back end engineer. I had to buy hardware. I had to put it in a managed service center and pay them every month to like rent the space on the rack. And all those costs for all those people and all that equipment was needed just to get it off the ground. So then 3 years later, AWS comes around and AWS is there. And now that same $50,000, well, first of all, AWS makes it free for startups for a certain period of time. Like, but
Even back then?
they were doing it more back then because they
really?
wanted to really
Growth
Yeah,
above all.
now they're tightening it up a little bit. But like back then, yeah, that $50,000 got me like 2 years. So, and then you keep going in the next sort of era of things. A lot of the infrastructure stuff that guy did, that back-end engineer did, is all now in the cloud and is all done by AWS. And so the cost of doing that went way down. Fast forward to where we are today, the cost of the front end goes way down with I mean, coding just has gotten a lot easier. And so I shouldn't say that. It's you can do a lot more.
You can do a lot. You can
less.
do a front-end engineer will on React will basically make a mobile app as well. So a mobile, experience can also be the app.
Yeah.
So 2 in 1.
Yeah.
But look at the barrier of entry. 15 years ago,
Yeah.
you had to buy equipment. You had to create technology to manage servers, which now are free essentially.
Yeah. Yeah.
Yeah.
So
it's so where we are today, what's really, and getting to your question about venture capital, it comes all the way around, is like it takes so much less to get so much further. And so that's what we're seeing is we are now having companies that will come in to see us to looking for raising capital. They're raising much less money to go much further. And they're already very far along. So they come in saying, hey, we've got, there's 5 or 6 people. We started this company 6 months ago. We're already doing $20,000 a month in revenue, and we've got 10 customers. And so you listen to it and you're like, wow, that's impressive. Like, that's not what we see every day.
Interesting.
Now it is what you see every day. And so then you get excited about it and you're like, okay, great, let's do a little research. And you start doing research and you find out that there's 25 other companies look just like these people, doing exactly the same thing. They started the company 6 months ago. They're already doing 20K in MRR. You're like, oh, so there's immense competition. And that doesn't even include the incumbents, because that's what everyone always say. Oh, well, we're doing this thing and Salesforce isn't doing it. Then they can't do it. They're too big. Well, guess what? Salesforce is a huge team working on AI related stuff. Huge. Their barrier to getting something out the door is higher because the quality has to be that much higher.
yeah, they're going to be slower.
They're going to be slower, but they have the distribution. They have all the customers. And so one of the things that's changed a lot in the venture world is what you look for in companies. So it used to be, what's your technical moat?
Yeah.
And now, like, the technical side is almost commoditized. And so what's really important now, and the things that we look at are the product side. Like, do they know intimately the problem, and do they know how to create a product that people are going to love and be sticky? And then do they have a distribution network, a go-to-market plan that is going to get them there?
But I think about this often, because if the barrier to entry is basically reduced to 0 and everybody's operating in a very highly leveraged state, so they can go much further with a lot less, whatever results they're getting that you're basing numbers off of, it's very achievable for a competitor to come and do the same thing, because like what stops them? The infrastructure is already commoditized.
That's why it makes it hard to invest right now.
Yeah.
Is because you see this guy 20,000 MRR in 6 months, and you don't know if there's going to be someone else coming with similar technology, because it's 3 months to develop and do 200,000. So
what is their unfair distribution advantage is the thing that we look for now. How are they going to get in people's hands faster than anybody else? And
so it converges to distribution.
This is a shift that's happening, and this is my point of view on it, is that it completely changes the game for venture capital as well, and it changes the game of what you're looking for and the type of skills you're looking for.
So it's not even the idea. Back in the days, people would invest in the idea. Then people would say it's the team. We're looking for that team that can execute.
Yeah.
Now it's something else.
You might want the team, but you need different people on the team. What is your go-to-market person, and why are they world-class? Whereas before it'd be like, we need a technical person that's world-class to build this great product. We'll hire the go-to-market person later on. Yeah, that's
Not anymore.
That's shifted around.
So John, I've heard it said, and I'm curious your take on this. I've heard it said before that, ideas are a dime a dozen. They're kind of worthless because it all comes down to execution. But if the cost to execute and the barrier to entry is so low, wouldn't it make sense that almost inverts, and that your taste and your quality of ideas, because they're so easy to execute on? But if we're looking at it just as like execution versus idea, right? I've always heard it said, like what really struck me was Jensen Huang with NVIDIA CEO. In an interview, they asked him, are you going to teach your kids how to code? And he said, absolutely not. Why would I do that? A computer is going to learn, or a computer is going to know how to talk to itself and write its own code so much better. What matters is history and philosophy and the humanities, and the ideas that my children are going to use to tell the computer what to do.
Yeah.
So what are your thoughts on that?
Yeah. So I think it comes down to validating those ideas, like against the real world, right? So you can have this great idea for a product, and now it's like, well, is this a product that people are going to buy fast? Is it going to be are we solving one of the top 2 problems that a company might have or an individual might have? And validating how easy we can get to them, validating our distribution. Like those are the 2 things that are like, the validation becomes a lot more important. Or you can just create a gazillion ideas into products really fast, but then how do you know which ones to put some marketing spend behind to attract customers? So I think it requires both of those things, but yes, it's a different skill set like that. Yeah. Coding is not the skill set of the future. It is the productization of that idea. That is a big, big thing. And that has always been important, but I think it's increasingly important. And then the go-to-market is the other part of it. So yeah.
I want to talk about AI, but first, let's go back to Organ Venture Fund and your 10 years of this journey is interesting. You've obviously, your job was to go out there in the market and connect with entrepreneurs, connect with every single new startup that spawns up. And first of all, in 10 years, do you see the numbers of these startups really grow by a lot? And also, can you talk about some successful stories of investments that OVF did that really outperformed the market?
Yeah. So yes, we're seeing, I think entrepreneurship in general is on the rise, that there's people it's easier to try things. And so people are trying more things. So just this Sierra that we just met in the coffee shop, she's hustling some, and because she could, and she started a business doing graphic design. And it's like, I'm going to try this other thing and this other thing. And the people are important. Like I didn't randomly start talking to her. I was like, oh no, I can recognize when we got, bona fide.
Oh, you didn't know her?
No. I just met her right there.
Oh, wow.
Yeah. I was like, just how she was talking.
So you have an eye for these.
You start to learn to see people that are bona fide entrepreneurs, and she's one of them. So, so yes, and you can do that, and that's part of the skill, I think, of figuring out how to do investments and like where to go. We were talking about George, our mutual friend George, who's part of the Oregon Venture Fund, and the company Hub. That was one of our companies here that we invested in. So Ali was a CEO. We had a pitch event, and she came up to me afterwards, and it was a 1-minute pitch. It was just this crazy event. It was just for fun, really. And she pitched her 1 minute, and she came up to me after and says, I'd like to have coffee with you in Vancouver sometime soon. I said, okay, great. And we went to the Compass Coffee here, and George was there just by accident. And so he and I are just sitting there chatting, and then Ali walked in. I'm like, oh, do you want to stay and do this meeting? He's like, no. And I'm like, okay, great. Well, Ali, can I get you coffee? And sit down here. I introduced the 2 of them. I go and get coffee for Ali and myself, and we come back and sit down. And George goes, "No, I'm staying." And I'm like, "Okay." And so he recognized the drive and the what we want to see in a CEO. In the 2 minutes it took me to get the coffee, he's like, "No, I'm going to stay in here more." And we ended up investing in that company. They did very well and had an exit a couple of years ago. So that's one company. Our network is great. So we've got these 200 people who all have their own networks and are all former entrepreneurs. And so a lot of the companies are coming through introductions from those places. So
networking was a big part of the success.
yeah.
And it's a very unique model for the Oregon Venture Fund.
It is.
Just the way the deal flow happens. Can you just talk briefly about that?
Yeah. So our model is we have these 200 venture partners who all pool their money together every year, and we invest in that calendar year. It's as a fund. So we, this year, the fund about $15 million all in, and we use that network then to help us find entrepreneurs. So some former colleague, a friend of a former colleague is doing something interesting. They talk to them. They have a rough idea of what we're looking for. They introduce them to us. We would have a meeting with them, and then we would bring in some other of our venture partners to help validate the ideas.
So just so I'm clear, let's just take 2024. Anybody who invested in 2024, that was just within that calendar year.
Yeah.
Whatever deals are happening this year,
It's the
the 2024 class or body, whatever you want to call it, isn't participating in this year.
Your portfolio is done.
Interesting.
And
So it's almost like a year, like each year is its own portfolio.
Yeah. So the concept that Eric had when he wanted it was like software as a service. This is venture as a service. And so every year you re-up the contract.
It's a subscription model.
It's a subscription model. Yeah.
Interesting.
And so at the end of so right now it's whatever, October, the 2025, we're finishing up the 2025 investments. And we went back to those 200 people and said, hey,
time to pay.
well, did you think we made good decisions? Like, do you think that the process led to good decision making? Do you feel like it's something that you want to do again in 2026? And usually it's 80 to 85%.
Raising money is very hard. For me personally, from my experience, it's easier for me to make money than raise money. Sounds like the criteria or the requirements to raise money is gonna really go up from here.
I think that is true. Like we're in a turbulent time. It's an uncertain time. Like 2 years ago, you said, we go back to our story of our 5 people doing 20K a month in MRR. We know what to look for. We know what to expect in a couple of years, or what we should be seeing in a couple of years. We know what that pattern looks like, right? That's venture capital is a lot about pattern matching, right? Of like, is this company going to match what these other companies that have been successful? Right now, it's really hard to say. And so, if we invest in that company, like maybe if they win even, and they beat the other 25 companies that are out there, and they get to be 5-10 million in revenue, what does an exit look like? So as investors, as venture investors, we need to believe we can get 10x return on our money on every deal. And so, but the problem is that the people that pay 10x are these big companies. And they often pay 10x not because for your customers, but because of the feature set that you have and the technology that you have. So I think one of the concerns that I have is that those buyers are going to be like, hey, so listen, instead of paying you, 8 times revenue, which is what they would typically pay for a SaaS company today, they're going to say, we really like what you're doing. We're going to pay you 2 times revenue, so $10 million. And you have $5 million in revenue, we'll pay you $10 million. Or we're going to just do it ourselves. And whereas that used to be a threat, it's not that much of it's easier. It's a lot easier for them to do it now. Or we're going to go to the other 24 and we're going to buy them and incorporate them into our product. So now selling a company, I think, is going to become a lot harder at the multiples that we've seen, which makes it a lot harder for us as venture capital investors to make our money that we need to see.
But if you have the word AI in your champagne,
Well,
then it's not that bad.
everyone's got AI in their name these days. So everyone leads with it. Everyone's got AI. And so, but it's, is it a bubble right now? Probably. Valuations.
Valuations,
yeah.
yes, but it's realistic. If it's true AI technology, machine learn, just a little bit more than machine
Yeah.
learning, then there's value, and it is. And if you have the distribution,
Yeah.
then it's interesting. Like Customer IO,
Yeah.
right? They're a large player in the market, and then they're introducing AI technologies that are actually valid and legit.
Yeah.
Then their value just keeps going up.
Yeah. And they have a lot of customers to sell it to already.
That's the thing.
Yeah.
They have distribution.
Yeah. But they've been around that's one of our success stories that we've invested in, I think 3 or 4 times or more even.
What was the deal? I'm just curious. At what stage they came to you, and what type of a deal? Because back in the days, what year was this? Let's look at this example. It's probably
I don't know the
5
specifics.
years?
No, much more than that.
Much more than that.
Yeah, I think the first Customer IO investment was the year that I joined.
Oh, wow.
So it's either when I became a GP or maybe even when I was an LP, like the first year I was an LP. So it could be 2013 or 2015. So it was very early on. I'm going to guess that they were sub 2 million in revenue would be my guess.
Still pretty good.
Yeah.
Startup.
Yeah. And so, but it's early stage, and it was probably a Series A, but I would imagine. And
Okay.
now they're on multiple.
Do you remember the valuation?
I don't. We've got 60 companies.
I'm just wondering if, because seems like closer to 2020 the valuations really exploded and we had this wave.
Yeah, it was probably sub 10 million is my guess.
Sub 10 million.
Yeah.
So that was a big hit for Oregon Venture Fund for the portfolio.
When they sell, it'll be great. Yeah.
Yeah.
So, but we only make our money when companies sell.
Mhm.
And so we've got, it's the downside of venture for some people.
No, I think they're
is
like
it's
a
long-term
billion.
play.
They're a unicorn level right now. No.
They're getting close. Yeah.
Yeah,
So-
something like 800.
Yeah. It's so when they ultimately have an exit, yes, it's going to be very good for all their investors that got in early, especially. So
Can you talk about what the biggest win for the Oregon Venture Fund was ever?
Absci went public.
What was the round that the Oregon Venture Fund got in at? What was the valuation, and then what was the exit?
We got in on every round. So we invested in Absci every year for 6 years.
Including like a seed?
Including,
Probably not.
Including, I think we were the first capital. We were along with Phoenix Ventures, which was the lead investor. We were in at that time, all the way through to the right before you go public round. There's a special mezzanine round financing, and we were part of that as well. So so that one we were involved in quite a bit. It's public now. And
What's the
biosciences have been hit pretty hard in the last couple of years, so the stock price is fairly low still. But it's one I'm very excited about still as a company. So
Maybe
it
it's a
works.
good time to invest.
It could be a good time to invest. I don't know. I find it very interesting. I'm investing in the company.
You still hold their stock aside from Oregon Venture? Do you have some of the stock?
I do. Yes, I've invested in the company. Yeah.
Well, no, it's
Personally,
great to support a local company.
Yeah,
and you also are local, and you have the kind of a unfair advantage of seeing what they're developing and seeing the traction and kind of believing in the potential.
Yeah. They have a tremendous amount of potential, it seems to me. And this is the synthetic biology and the areas where AI can really impact things, and biology is one of them. And so, and they have invested enormously in this area. And
Would you introduce me to the CEO? Or?
Sean, when he gets back, he's on vacation right now. So
I just want to see their facility.
Great guy. Yeah, he's phenomenal. A great guy.
I drive by their building. I'm like, what is this? What is this?
Yeah.
I haven't.
They have all labs because they use AI to determine what drugs they want to create or what the targets are, but you still get it. It's just a lot. And then you have to go and validate it in the lab and say, oh, we think that this is a good drug to do this, or resolution or way to solve this problem, but we don't know for sure. So now we have to go and validate it in the lab. So, yeah.
I know that Oregon Venture Fund is looking at about 300 companies. They're
A year.
they're looking at the decks, and then they're interviewing 50.
So, yeah, the way that it
They're
works.
actually doing due diligence on how many.
The way it works is that myself and Deepthi, who's the partner doing the front end of this process, we would meet with about 300 entrepreneurs a year for a half-hour meeting probably. And then there's about 50, that we bring in. And what we do is go get expertise from our 200 people, our venture partners. We would say, hey, you have expertise in this area, and we try to triangulate it. And so we might say, oh, this is an e-com company, you have expertise in e-com, you have industry expertise in the market they're going after, you have just expertise in general startup land, like how startups operate,
Right.
and experience in that, and that general experience is really valuable to us. So we try to triangulate it, and from those 50, we do an hour-long meeting with the entrepreneurs. We get it down to about 10 that we start diligence on.
Oh, 10.
Then we start to, because diligence is expensive and hard. Like when we go into diligence, we're gonna
Spend money.
we're gonna talk to all of your colleagues. We're gonna talk to your employees. We're gonna talk to the people who used to work for you. We're gonna talk to your previous boss. Like we're gonna really understand. We're gonna go talk to your customers. We're gonna talk to get an independent point of view on the industry. Like, is this a real
like
company?
an investigation?
It's an investigation. So we do that. We really want to make sure when we start diligence, we want to make sure that we have a really high likelihood that we're going to get to the end of it. And then
50%.
And then about 5 we do investments in. So yeah.
So imagine 300 initial calls, 5. That's what, 1.5%. That's crazy.
Yeah. And so the rest of them is like we're saying no, not yet, or we're not. It's not something for us. I'd say in our case, because we're only regionally focused, there's about 200 that are just not venture. Honestly, they're not just not.
It's not venture. Well, it's not
I spend half an hour saying, here's the other things you should be thinking about. Like you're not going to venture's not a thing for you. So let's talk about your business and how to fundraise for it if that's what you need. But it's not going to be from venture funds. Like don't stop watching Shark Tank because that's not the way you're going to go.
Yeah, a lot of people dream about going on Shark Tank and exploding.
Yeah.
And yes, you see some cases where they would use some of that footage from Shark Tank, put it in the ad, and spin off, and actually,
Shark Tank's great for marketing.
It's amazing for marketing.
Yeah,
and a lot of people go there for that.
Yeah,
they're not gonna get a deal.
Yeah,
they rarely get actually featured and shown on the show.
Yeah, we've had a couple local companies though that did really well for their businesses and almost killed them in some cases.
Wow.
Yeah. So Pan's Mushroom Jerky was on there. They do jerky instead of beef jerky. It's mushrooms made out of mushrooms, and it's really good. But they, I think he told me they had done like $1 million until the show, and the show was November 15th. And between that and the end of the year, they did another $1 million.
Wow.
It was like crazy. Rumpel was on Shark Tank.
So just exposure.
Yeah, it's really good for exposure.
I want to share an experience that I had with Oregon Venture Fund, that when we were raising money, and unfortunately we didn't get through, we didn't get to raise, but we got a reality check, because a lot of times entrepreneurs and founders, they live with illusion, and they think, okay, their idea is bulletproof and it's great and we're gonna get it done. And sometimes they think about a valuation that is also unrealistic. So a good reason, in my opinion, in talking to funds like Oregon Venture Fund, is you get a reality check. You actually understand where the market is. You actually have people look at your business and say, hey, this is actually a scalable, viable business, or not. So for example, for us, we were building some sort of a marketplace, and Oregon Venture Fund said, I don't think it's going to work. And we thought it's going to work. and actually it's working, but we actually went to a SaaS model, and now there's something interesting that's happening that's really really working, and that's marketplace.
Yeah.
We found a way to solve the chicken and egg problem.
Yeah. And it might be that we didn't think that it was a good business. It's just, again, we have to get 10x return on our money
Yeah,
in a certain period of time. And so we're looking to invest when you've done that learning already.
Mhm.
And you're like, okay, now we know the exact thing that's going to work going forward. And we've got enough proof points to show that it is.
exactly. But you guys helped us polish.
Yeah.
And I also talked with my other business, Snap Supplements, to some PE firms, and they kind of put me back in place where, hey, don't think about your business as 15x. Like, growth is great because I was growing at 50% year over year, but we're looking at EBITDA.
Yeah.
And I said, well, how can you look at EBITDA when I'm growing? I'm almost doubling. So last year we doubled.
Yeah.
And he said, well, we'll try to calculate, remove some, basically come up with a formula to show the realistic EBITDA of the
Yeah.
business. And we're still going to give you a multiple on the EBITDA. So that helped me change my mindset.
Yeah.
And back in the days, past 5 years, we were break even at zero, maybe made $500,000 a year, and that's it. This year, we're going to do 10% net.
That EBITDA. Yeah. That's
So now all these guys are like, okay,
great. Right.
okay, now I like you.
Yeah. It's different investors, right? PE is looking at they have different set of criteria. Growth is not the same, right? They want growth,
Mhm.
but they want you to do profitable growth.
Yeah.
Whereas when you're at an early stage venture, like we don't want profit. We want your profits to go back into growing faster. Like that's the to a point. Like it's
Well, we're going to double this year.
yeah, that's great.
We're going to double, and we have 10% net.
Great.
And it's just a shift in the mindset.
Yeah.
It's like, guys, break even is not good. It's not good. Maybe in SaaS, maybe in a different type of business, where a marketplace where we're trying to get market share, and you don't care about any profits at all because you have investors. They're gonna be putting money into you, and it doesn't matter. But specifically in the supplements and the wellness, I realized that it's very important, because if there's a little bit of headwind, you have this cushion, you have ability to, maybe your EBITDA or net profit will drop to 5%, 3%, but you're still going to be growing. Versus if you're at break even, there's headwind, all of a sudden you burn 250,000.
Yeah.
Which actually happened to us last year. We were going at roughly about 3 to 5%. And then we had a massive issue with TikTok, and we burned $1 million in the span of about 60 days. So we came out break even for that year. But I realized how important it is to actually have those profits, have the cushion, have that cash flow positive. And
it's interesting. Every type of industry has different ways of getting valued, right? And so consumer products is one thing, e-com is another, marketplace is another way to value company, SaaS is another way to value companies. And so it's always like, when talking to investors, like knowing where you fit and what you are, and that's why when they ask, like you were saying, oh, the marketplace or a SaaS solution, like being super clear about that, to tell the investor, oh, this is the bucket. Here's the lens I should be looking at this company through. And the criteria that go with that type of a company, you're telling me how I should think about it. And then also that informs your valuation too.
Yeah. And I'm in startups for 15 years, and I'm still learning. I'm still in some ways delusional about certain things. So I think talking to an investor,
why you're a founder.
I believe my word more. But the reality is, you have to go and speak to investors, or not necessarily to raise money, but at least to understand, hey, is the path I am in is working? Is it valid? Should I continue? Should I pivot? Should I make some changes? So I personally think, even though we never raised for any of our startups, I do believe that it's valuable for a startup to at least start some conversations.
Mhm.
Don't think, well, some people say, I don't care about investors. I don't want to waste my time.
That's fine. Like that's totally a legitimate path to go down. You might use it for, you might talk to investors for knowledge, right?
That's
And
exactly.
yeah, and for guidance.
And you
Yeah.
should.
Yeah.
You should.
Yeah. I always, I mean, even for our companies that take investment, anytime you take investment, it should be for, there's only two outcomes.
Mhm.
You get to break even, or you need to meet the milestones to to get your next round of investment. And
Mhm.
so it's always planning on what those, like, which are you going to get to? And if it's this getting milestones to get your next round of investment, you better go talk to those investors who are different than the ones you talk to today, because they're at a later stage, and understand what they want, because those investors want different things.
Exactly.
And like, what you might look at it from a pre-seed or a seed to a series A is one thing. You get to series B, that's another thing. Go talk to a PE firm and they want something different. And
Mhm.
so understanding, so always talking ahead
Yeah.
to investors is really important, I think. So
And also the exit strategy as well. So
that's,
is that sellable business? Is this a business that will complement another player
yeah.
in the industry that can swallow you, can acquire you,
Yeah.
or it's what's the strategy? Is it
Yeah.
is it IPO? Is it
I,
get it to 50 million and sell?
yeah. I think a lot of founders, like, that's a key. Like, why are you starting this company? And what is it that you want to be? And I think one of the questions I ask a lot to, especially technical founders, is, so what do you want to be doing in 5 years? Not what the company is, but what do you personally want to be doing in 5 years? And they're like, well, I want to be creating products. And I'm like, great. Well, so then so you don't want to be the CEO? And they're like, oh, well, actually, I want to be the CEO. I'm like, great. Well, in 5 years, if you're successful, let me tell you what you're going to be doing as CEO. You're going to be having meetings with the disgruntled salesperson about why their territory got changed. You're going to be having a meeting with this other person. And they're like, oh, I don't want to do that. I'm like, no, I know. So think about what it is that you want to be doing in 5 years personally, because you're going to spend all your life doing this, or you're going to spend all your time, substantially all your time, on a startup. So make sure you're going to spend your time doing the things you like doing and want to be doing.
So there's not just exit strategy for the company, but also there's exit strategy for the founder.
Yeah. Yeah.
Is it do you want to continue for 10 years and
Yeah.
eventually your roles will change? Eventually it's going to become more corporate, and it's a lot of bureaucracy and
It's
things like
just
that.
the reality. You've got employees now you've got to deal with, and that's a
Yeah.
whole nother story, right? And so, yeah, understanding that. And I think, yeah, going back to your point on the exit strategy for the company, I don't think it's, if your goal is to exit, then yeah, you should have a strategy. You should know who the top 5 most likely acquirers are and why.
Exactly.
And you should go start relationships with those people now. And so that when, when you're ready to sell, you're not selling the company, but you're getting bought, and positioning the company so that people want you and they know why they want you, and you know why they want you. And you've been able to position things accordingly so that those things align and you can maximize your value going out.
So you basically polish your value, your offer
Yeah.
to this company. So if you know that XYZ likes you because of this, maybe you can improve that side of business. And
That's right. Or when you talk to them, at least you can emphasize those parts of it. But I think it's a 3-year strategy.
It's a 3-year strategy.
Yeah.
Wow.
So there's a guy I've been working with that's trying to sell his business, and he said, oh, I want to sell. I'm like, okay. He's like, what do I have to do? I'm like, well, you start with a plan for 3 years from now. And he's like, really? I'm like, yeah. I mean, you can sell today, but then you're selling the business. And you can do that by, you going to a broker and selling it, or you go to all these people. You're selling, right? What you want.
You're not going to get the value
You want the guy that's going to come knock on your door to your house and be like, hey, I love your house. I'd like to buy it. And I'm going to pay you top dollar to get it because I like it. It's it's a very different thing.
Yeah. Completely different.
Yeah.
dynamic.
And so thinking about the exit is important if that's your goal. Like, some people are like, no, I want to run a company. I'm working with one company, and they're like, no, we have investors. We want to get all investors out and go in essence, go back to being a private company again, because the objectives of what I want to do are not in line with the financial objectives of the investors.
Yeah, but there's so many stories of people not selling and then regretting,
Yeah.
and then the market shifted.
Or
Their business is becoming less valuable,
yeah.
and then there's massive competitors that came in and were able to strengthen their positions,
Yeah.
and become much bigger, and they just slowly dying.
Yeah. I think that is a real concern for a lot of businesses. That's why I think it's understanding what you want to be doing with it. You don't,
Mhm.
I got another friend. He does it's a different kind of, it's a carpentry business. He makes furniture. But he's like, I'm 66 years old. I'm ready to go travel and retire. How do I get out of this business? and then there's no, because he hasn't planned enough to get there. It's a little difficult because my answer is the same. It's like, well, let's plan for 3 years from now.
Hmm.
And he's like, yeah, how about 3 months from now? I'm like, no, that's a different thing. And so I do think it's like setting all those things up and
Mhm.
thinking about the ultimate exit in any kind of business is a good idea. Unless you got, your kid's going to take it over and it's a family business.
Yeah, if you have a plan, basically you have to have a plan. If you think about exiting, you need 2-3 years, up to 5 years.
Yeah.
If you don't think to exit, you need somebody to replace you. So
Yep.
you need the right management, executive team, a CEO potentially to replace you. So
Yeah.
that's good.
John, let's zoom out, and I want to ask you something that's quite controversial. Portland metro area.
Mm-hmm.
You run, or you're closely associated with the Oregon Venture Fund. Portland is center stage right now. Okay, there's a lot of people in Oregon. The Oregon governor going on the news saying we don't need federal agents coming to our city. I don't remember exactly who it was, but I saw a clip where they were saying that Portland had 9 consecutive quarters of decline in, I think it was payroll or some sort of metric. You're intimately connected to this part of the country. Well, what do you think about investing in Oregon and Portland specifically? How does the changing political climate affect your decisions? How do you think about getting a return for investors when there's so much negative PR in this part of the country?
So, I'd start by saying that the Oregon Venture Fund, we are geographically bound in our operating agreement. We need to have a C-suite person or a founder in the region. And that's always been the case. And that's our unique differentiator.
But not necessarily Portland, it's Oregon.
It's Oregon.
And Southwest
Oregon
Washington.
and Southwest Washington. Yeah.
So how far do you go? To Seattle?
No, to
just Vancouver.
The adjacent counties,
County.
maybe?
Clark County.
Clark County.
Yeah, pretty much. We looked at companies in White Salmon area, but we've never invested outside of Clark County.
But Hood River, no problem.
Yeah. We have companies in
Bend, no problem.
We have companies in Bend. We have company in Medford. We've got companies in Corvallis and Eugene.
And so it's literally in your operating agreement that you have to stay within a certain geographical location.
So that's our unique differentiator. Like otherwise, what makes us different, right? And so, and it's one of those constraints that's actually an opportunity because it means we see every single thing. We ought to see every single deal that's in the region. I would say like one of the things, I'm downtown every single day. I don't know what federal troops are going to be doing. What are you going to do? It seems
leaves.
pretty normal to me. But whatever.
It's probably at night.
I'm there until 10 o'clock at night every day. There's no problem.
I think there's really only one spot in the whole city, which is the ICE facility.
No, but forget about the federal groups. The situation in Portland is pretty dire. Look at the buildings.
So downtown, so that's a different thing. Like
economically,
sending troops are not going to help anything downtown.
Yeah, it's
right?
economics.
So that's ridiculous. What happened with COVID is that, right before COVID, downtown was very vibrant, right? All the tech companies had moved downtown because their workers wanted to be places where there's cafes and restaurants
Yeah.
and
So
things
it's a
happening.
good food scene place.
Right. So downtown was that. And like Jama was there, Casmaraya was like all of the big companies had offices downtown. With COVID, everyone went to work from home.
Mhm.
And what happened is that at least for the tech companies, is their workers are like, hey, I live in Northeast Portland. I live on Division Street. I live in Vancouver. My neighborhood is great. And there's lots of restaurants and cafes and things to do in my neighborhood. I don't need to go to downtown anymore. And so the local startups are not like, there's no reason to have an office downtown anymore. And so it starts the cycle. And I do think, at least I think that they're going about it slightly backwards, where the landlords are saying, hey, we need to fill up our buildings. We'll give you company a break on your rent to move back in. Like, well, the company isn't going to take that, first of all, because there's so many people saying it. And the workers don't want to come in.
No, that's part of the problem. But the rent, the cost per square foot in Vancouver,
Yeah,
waterfront, downtown area is higher than Portland.
I believe it.
And people
Should
and
be.
buildings. Well,
It's
what's the
great-
reason?
Because there's things to do. People want to come work downtown.
Well, hold on. You just said people don't want to go to downtown.
Downtown Portland, right?
Why?
Because there's nothing to do. Like the restaurants have shut down.
No, they're
It's
still
pretty
open.
desolate depending on where you
Yeah.
where you
So
go.
I think that the way to get Portland, if you want to attract companies to have their workers come back downtown again,
Mhm.
you've got to incentivize the street level. You got to incentivize the restaurant. Give free rent to the restaurant that's going to open up there. The entrepreneur that wants to start a restaurant, the entrepreneur wants to start a cafe.
I think most of the restaurants are still doing well.
Mhm.
Oh, most of the restaurants
that are left downtown.
But who shut down? I don't even know
So,
who shut down.
so I'm just talking about downtown Portland.
I am talking about too.
Yeah. So all the neighborhoods, restaurants are doing great. And this is the change. And this is what I think is fine, is that Portland, the whole metro region is a region of neighborhoods, right? If you think of downtown Vancouver as a neighborhood, you got what's it called? Uptown. It's another great neighborhood,
Mhm.
right? Philita's got its own neighborhood. Like there's neighborhoods everywhere. And it's the same in Portland. I live in Northeast. There's Alberta Street's got its own neighborhood. Mississippi Street's got its own neighborhood. I live off of Broadway. There's its own neighborhood. There's Beaumont. The neighborhoods have all thrived, and they're increasing all the time. Like I think that all the neighborhoods are generally doing better. Downtown is not, because people aren't going back downtown. But that's the thing that you see on the news. And so my personal experience is that we have seen an influx of people of entrepreneurs moving to Portland, and they're not going downtown. They're moving to either one of the neighborhoods. The hottest neighborhoods in Portland right now are downtown Vancouver and Milwaukee, in my point of view. And
I think the bigger issue is not the federal building, the ICE building, the federal troops that are. It's minor.
yeah,
It's no problem. What you said, payroll. Companies are moving out of Oregon because of politics and because of deficit.
yeah.
And they just did a hike on taxes again.
Yeah.
And
So
it's
because we don't work with bigger companies as much, unless they've grown to that. Typically, and in my world is sub 100-person companies. And what we're seeing is that we're seeing people move here by choice, because the real estate here is the cheapest real estate on the West Coast in a metropolitan area. And the whole metro area here is less expensive
on the
than
West
LA.
Coast, yes.
And so we've seen an influx, but people want to live on the West Coast. And so they've moved into the West Coast. We've seen an influx of our entrepreneurs that are the founders that we're investing in. They're coming from LA, San Francisco, and New York. They've moved here, and they're driving prices up because they can afford. They love the prices of real estate here compared to the Bay Area or LA. And so we're seeing people moving here, and they're coming with their startup. They're coming with there might be a VP of marketing in a startup, and that qualifies for us to invest in them now.
So you're saying it's good. The the economy, Oregon economy, and the regulations and
No. I think I don't think it's as business friendly as it needs to be. And I think it's skewed where it is business friendly.
is it?
Towards,
It's not.
well, I think it's
Towards
I mean, I think and it's probably everywhere, but it's skewed towards, landlords that control the buildings downtown. It's skewed towards bigger companies. Whereas I think what we're trying to build is an economy that is extremely diverse, that has lots of smaller companies in it. And
Okay.
so I think I one of the things I used to say is like, I would love to see the Wall Street, if there's a next recession that happens, there's an article in the Wall Street Journal about the whole country is being hit by recession, but the metro region of Portland is being hit less because of its diverse economy
interesting.
of different startups.
Mhm.
Like, I would take that as a win.
That would be one.
That would, yeah. So
Does Portland have a PR problem?
yes, at the moment, I think it's changing. I think one of the problems is just a perception of people that live here too and start to say things. So I did last year. There's a guy named Randy who puts together this. It's called Best Practices Tours, and
Tours.
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 And so he gets a group of people, 100 people from Portland, and the one I went on was to Sacramento, California, and you go there and you spend 3 days. And he's organized it so you're hearing from the city officials there. And what's interesting is these 100 people are city officials here, and public and private people. And so you go, and the first day, 9 o'clock in the morning, was an hour with the county commissioner.
Mm-hmm.
And the next hour was with a city council person. And they're talking about the problems they have, arguing between whose jurisdiction this is and that is. And what's really cool about these things is, like, then you walk to the next venue and you just start talking to the person next to you, and I'm like, oh, so what brings you here? I'm like, oh, I'm a county commissioner for Multnomah County. I'm like, you mean like that person that just spoke? She was like, yeah. I'm like, oh. Like, well, tell me do we have the same issues? She's like, exactly the same issues. Like, it's all like, it's just the nature of the way things are. And then that person chimed in on the other side and was like, yeah, I'm a city council person. And they're like, oh, hey, how are you doing? They know each other. And it was just fascinating to hear how government works or doesn't work, and and these are the people involved in it all. What was really interesting is at the end of this 3 days of looking at Sacramento, we're kind of like, the general consensus is actually we're doing all right. Like,
Comparatively speaking,
like, we're super down on ourselves because we want better.
Yeah.
But relatively speaking, we're doing okay. So we clearly have a huge homeless issue in Portland that needs
really
to get
high unemployment rate, 5%.
Yeah.
And I'm curious from your perspective on the venture, or on your perspective on the investment of local companies. If you could enact certain changes at the city, at the county level, what would you change so that way you would improve the city?
Yeah. I mean, I think the tax issue is a big one for investors. And so high net worth people move out. And some of them move here before they exit their companies.
Well, Washington has the same problem.
It's starting to have the same.
Yeah. It's certain bracket.
Yeah.
I think it's $1 million plus.
Yeah.
But it's a big issue when you pass away and you kind of transfer the wealth.
For estate
kids.
tax. Yeah.
Yeah. They take a good cut.
Yeah.
Of that portion.
Yeah. So I think, or if you sell your company, you have the capital gains tax on it. That's higher.
That's additional 8%, and it's actually a big deal for me.
Yeah.
Like, if I sell my company, aside from 21% federal, I have to pay 8% additional to the state.
Yeah.
And Florida doesn't have it.
Right.
So now I have to make a choice.
Right. Or Nevada. Right. So people are.
I have to make a choice, and it's like, I love the city. I love Vancouver. I lived here more than half of my life.
Yeah.
And now they're really squeezing me out.
Yeah.
before I sell, I have to move. That's basically kind of the
Yeah.
what's on the table.
Yeah.
And aside from that, there's other things. They just introduced a sales tax on leads. So
Oh.
if you're in lead gen business, there's
Huh.
also additional sales tax on marketing expenses in Washington.
Oh.
So, and Amazon is going to be taking automatically tax on top. So you're basically, we have to stop advertising on Amazon
Huh.
in Washington State as of right now. There's different exemptions that you can submit, but
Huh.
it's very, very unpleasant for entrepreneurs and business owners.
Yeah. I think that just going back to your question on what can the city, I think supporting, recognizing entrepreneurship as a driver for so much of the economy
Yes.
would be a really good thing. The problem is that and the good group like Portland Business Alliance and people that run those groups are funded by big companies. And so therefore you get the interests of those people. That's the voice that's becoming
the small ones, right?
the voice of entrepreneurship and recognizing that this is where a lot of people work, whether it's small business or venture scalable businesses. And that's what's driving
The
the
decisions.
new opportunities and the new wealth in the region. I think getting that more front and center would be a really good thing.
Do you have any levers at Oregon Venture Fund that could, at least, can you make a case? Can you come up to the?
We've really focused on, frankly, just raising the story. And so, like, it was interesting, like, Tobias Reed is the Secretary of State now, and he was the treasurer, and he was at one of our meetings once, and he spoke up and he stood up in front of the group of 500 people, and he's like, you all need to reach out to your representatives. They need to know what you're doing, and they need to know what the Oregon Venture Fund's doing and talk about this stuff. They just don't, they hear from the big business. They don't hear from people
Right.
like you. So I was like, okay. So I reached out to the city council, just emailed them, and I emailed all of them, and one of them emailed back. And so Eric and I went over, and he's like, what's your agenda? I'm like, no agenda. We just want you to know about us and what we do and why we do it. And he's like, this is great. I didn't know any of these things. And so I just think it's doing a better job of making sure elected officials,
Kind of raising awareness about the startup world, the
Yeah.
economy that we're bringing.
So I've been, like Business Oregon has this innovation plan that they've been working on, and I've been advocating it's all across the state, and there's all these centers of innovation and helping entrepreneurs. I'm like, great. How much are you tracking that? Like, let's be able at the end of the year say, we worked with 1,500 individual companies across the state, and who employed 5,000 people, let's say. And the next year be able to say, hey, remember those 1,500? They now employ 10,000 people. Like showing that and making the case for why the innovation engine of the state and of the region is going to be what drives the future. It's not,
But you remain bullish on Oregon as a playing field.
I love living here. So it's not, I'm choosing to pay a little bit more for the benefits of living here. I'd like to see more of those benefits, downtown in particular, in terms of like just how do we, yes, it's not pleasant walking around with so many people that are having issues.
There's some stories I don't even want to mention that happened in downtown Portland. But
for the past actually 5 years since we moved there, I'm downtown every day. I'm often downtown till 10 o'clock at night. I'm often I ride my bike because I live close enough. So I'm at street level all the time.
No, it's generally pretty safe.
And I don't.
But it could be better.
It could be way better, and I remember it better as well. But I also then you get outside of downtown, and I think the region as a whole is growing. It's just growing in different ways than the visibility of downtown. So when I moved here, I never went downtown. I had never reason to. I shopped in my neighborhood.
But all the good restaurants are in downtown.
Yes, there's
even for me living in Vancouver, we have options here, but for the for the higher quality, for better taste,
Yeah.
for more interesting options, I go to downtown.
Yeah. But the neighborhoods also have a lot of good restaurants in them.
Where?
All the neighborhoods. I mean,
You mean here?
I know.
Oh,
less-
like outside on the outside.
Yeah, not downtown
Outskirts?
Port Lake. If you go to Alberta Street, for example,
Yeah.
Alberta or like Selwood or
Yeah.
Hawthorne. Like there's a lot of
There's
good
a
spots.
lot of good restaurants that are coming up in the neighborhoods. It's just not, it's not in
Yeah, you're
considered
right.
the
You're right.
downtown. So, and they have some old school
All
restaurants.
my favorite restaurants are in Portland. So
Yeah.
John, one final question that we ask to almost every guest. What would you tell a young and up and coming entrepreneur that is just starting a business from your perspective as an investor? You don't know the business they're in. You just know they're young, they're bootstrapping a business. Given the climate we're in, both technology, the technological climate, the economic climate, what would your most broad but like most pointed advice be to an entrepreneur in today's climate?
I think it goes back to the comment earlier, like, what's your objective personally? What do you want to be doing in your life? Like, what do you want to be doing in 10 years from now? Because how you set up your business, whether you take investment or not, who you take investment from is all going to help determine that. And so make sure you really spend some time thinking about that and understanding that before you get too far down a path. And then usually if I'm talking to them, I'm like, okay, why do you want investment? And understanding what that means for you. And most of the time I'm like, yeah, you don't really want investment. That's not the path that you should be taking based on what you just told me. So
awesome. Well, thank you so much for your time, John.
Thank you.
Thank you.
Appreciate
Thanks.
you.
It's good to see you again.